Okay, traders, now it's time to get you up the curve on one of the most important aspects of the market, the fundamental analysis. Now, this is one area that 98% of the Forex trading coaches out there won't be able to tell you anything about because they don't have any experience in the institutional side, right? In the banking game, it's all about the fundamentals. Of course, the technicals are a key component to identifying trading opportunities, entry and exits. But when it comes down to the fundamentals, these are the components that give the markets direction. And that's why it's very important to understand how they work and where you can take advantage of them. All right, so let me just run you through a slideshow first, then I'll show you exactly where they fit in and how it all connects, right? It's quite simple when you break it down to the core components. All right, so let's get started. So, what is fundamental analysis and why is it important? Well, this is what really drives market direction. Okay, it brings all the economic numbers together. The central banks are largely involved at managing the economies, and they are looking at the economic data and geopolitical issues which could disrupt economic activity. Now, let's just start with the basic principles of currency value. Okay, it's all about supply and demand. And what impacts supply and demand? Well, largely interest rates. And secondly, economic activity. But this is the most important aspect, interest rates. The higher a country's interest rates, the stronger the currency relative to other currencies. That's the most important aspect. So if you want to break it down, it's the interest rates that are the most important component of the fundamentals. Now, the central banks, they manage the economies and economic activity by looking at the core drivers, macroeconomic data and geopolitical issues. Okay, if they see any instability either way out of these two core components, then they adjust interest rates, which adjusts consumer spending and saving. But the main data the central banks watch, it's all about one key data release, and that's the CPI numbers, Consumer Price Index, otherwise known as inflation. And the central banks, they manage the economies with a very tight grasp of inflation. Now, most of the developed central banks have an inflation band between 2 and 3%. Now, what that means is if inflation drops below 2%, they cut interest rates, try and reduce people saving and get them spending their money to increase economic activity. If inflation goes above 3%, they hike rates, try and encourage people to save money, slow down economic activity. If they can keep inflation within the 2 to 3% inflation band, then they know economic activity is just going to remain consistent. So all they have to do is keep an eye on the inflation numbers. It's quite simple. Now, why are interest rate changes important? So if inflation is greater than 3%, the central bank hikes rates. And why is that important? Because higher interest rates means a stronger currency. And if inflation is less than 2%, well, they cut rates. And that leads to a weaker currency. Now, the traders know exactly what the central bank plan is because the central bank tells us every time they have a meeting. So like the central banks, the traders watch the CPI numbers very closely. And if they see strength or weakness outside of that inflation band, well, then they start buying or selling a currency relative to the release of the data. And that's the key to it, right? We don't have to wait for the central bank meeting in, say, 4 weeks. When the inflation numbers come out, if they're greater than 3%, we know what the central bank is going to do. So they start buying the currency and vice versa if the inflation rate is below 2%. This is why the markets move well in advance of the central bank meetings and why you see the big moves on your charts. Now, for example, if the Federal Reserve, right, the USA central bank raises interest rates, the US dollar goes up. Now, that means at that point, Aussie, Kiwi, Euro, and Sterling would go down. Okay. And dollar yen, dollar Swiss, and dollar CAD would go up. So if we saw the economic numbers come out stronger than 3%, that's the exact move you're going to see in the market. And vice versa, if the Fed cuts interest rates, well, just the opposite happens. The US dollar goes down and the market will buy Aussie, Kiwi, Euro, and Sterling and sell dollar yen, dollar Swiss, and dollar CAD. This is the core principle that the markets operate day in, day out. Now, there's a lot of data that feeds in to the inflation numbers. And understanding the hierarchy of the data is important. The interest rate decision would be at the top, then the inflation numbers, then unemployment, the GDP numbers, retail sales, consumer confidence, and a range of other economic numbers. Now, you don't need to understand the backbone of all these numbers. You just need to know if it's stronger, it's going to lead to higher inflation. And if it's weaker, it's going to lead to lower inflation. So depending on where inflation is in relation to that 2 to 3% inflation band is key to knowing whether you should be buying or selling. And so there's no need for guessing this. There's like a 6-week cycle for the Federal Reserve to make an interest rate decision. And that's the same for the economic data. And this cycle continues year in, year out. Okay, so if you're looking for answers as to where the US dollar is going, well, we have a cycle of data that you can track very closely. If the numbers are stronger, well, that probably leads to higher inflation. So if all those numbers keep going up, it's more likely the central bank will raise interest rates. If the data is a bit up, a bit down, well, you know what? They may not do anything. And this cycle continues throughout the year. Now, the economic data schedule, this is also important. Now, the first 2 weeks of every month, we get the key macro data, the really important numbers, inflation and employment. And you see significant moves if there is variation in the release of this data. Now, the second 2 weeks, we get the micro data, what I would call second or third tier numbers. They don't have as much impact as the inflation and employment numbers, but they still are building blocks of the inflation number. Retail sales, housing numbers, etc. And the last week of the month, well, there's not a lot of data coming out. And usually it's characterized with a lot of central bank speeches. And what the central bankers are trying to do is keep your attention focused on the next few weeks where we do get the inflation and employment numbers again. And this cycle continues month in, month out. So traders globally, not just the traders at the banks, they keep an eye on the economic calendar. So in our course, we go into detail how to read the economic calendar. It does look like there's a lot of information, but a lot of the data on this page here is not even that relevant. Third tier, fourth tier numbers, yeah, they're building blocks, but they don't really impact the inflation numbers. And your job to keep a track of the fundamentals is just to keep track of the news. Is there anything significant geopolitically or an economic number or a central bank announcement? And that's largely what professional traders are doing continuously. Just keeping track of the news, making sure if there's any adjustments in the expectations for inflation, they understand what it is and they can make trading decisions based off that. So when you're looking at your charts and you see big one-way moves, they're not technical trades. That is the fundamental data being factored into the market. The fundamentals are the core driving components of market direction, and you need to understand that CPI, well, that's the main game, and that's what you really need to focus on when you are starting out trading. And the fundamentals are a key component of our live trade hub, the major support arm of Traders for Traders. We're always trying to keep track of what's going on with inflation and the US dollar. And this is where the economic calendar comes into play. Understanding what the numbers are and what the expectations are and how to hit the market should the numbers come out strong or weak. And this is all you're doing. You're keeping track of the economic calendar to see if anything comes out that's going to impact inflation. If it does, well, we may have a trading opportunity on the fundamental side. So staying ahead of the market is quite easy. And believe me, although the calendar may look quite extensive, it's very easy to understand. And I'll cover that in another video. Okay, so that's the core principles of fundamental analysis. All you need to be focusing on is inflation. Are the inflation numbers outside the 2 to 3% inflation band? If they are, you have a clear direction in the market because we know exactly what the central bank will do if it breaks outside that inflation band. And you can apply that theory straight away into your trading. Now, each month, there's 7 top tier inflation numbers out of the G7. These are all great trading opportunities. And now that you've got understanding of how it works with the central banks and the inflation band between 2 and 3%, you can take advantage of these releases and add it to your strategy collection. Now, we go into a lot more depth around the fundamentals in our course. So if you do want more information, we'll join the Primetime Trading program And not only will you get access to the masterclass course and learn how to trade the macro fundamental releases, we'll also coach and mentor you through that learning process. Good luck, guys. All the best and happy trading.